Welcome to the deep dive. You know that mid-year economic feeling, right? Often, the headlines can create a bit of a, well, summertime sadness kind of vibe. Talk of inflation, geopolitical tensions, maybe trade skirmishes. But what if we told you that even amidst these significant headwinds, there are surprising pockets where the economy is actually, well, walking on sunshine? Today, we're taking a deep dive into the latest mid-year economic outlook for 2025-2026. This comes straight from a comprehensive report by Allianz Research. Our mission really is to cut through the noise and quickly unpack the most important insights for you. We'll try to identify what parts of the global economy are truly under pressure, how central banks are, steering through these waters, what strategies businesses are adopting, and where capital markets are finding surprising resilience despite all the geopolitical uncertainty. Think of it as your shortcut to being, well, pretty well informed on the global economic pulse. So let's unpack this. What's the big picture for global growth as we look ahead to 2025? Are we bracing for a significant slowdown? And what does that mean maybe in historical context?
We certainly are looking at slower momentum. Global growth is projected to remain under pressure, settling at a modest 2.5% in 2025. Now, the real insight here isn't just the number itself, but that this is the slowest rate we've seen since 2008 if you exclude those deep recession periods.
Wow. Okay.
So yeah, it signals a uniquely subdued pace for the sort of foundational engine of the global economy.
Yeah.
It forces strategies we haven't really seen in over a decade.
That's a powerful benchmark. How does that slow global momentum break down across the major regions? Is it weakness everywhere or more of a mixed bag?
Definitely a mixed bag, yeah. With some interesting shifts, actually. The U.S. forecast, for instance, has actually seen a slight upgrade. It's now plus 1.6% for both 2025 and 2026, partly due to some tariff developments we can talk about.
Okay.
In contrast, the Eurozone, well, it's expected to see growth at plus 1.2%, but that's largely propped up by its smaller economies. Germany, a key player there, is projected for a mere plus side 1% in 2025 before a modest recovery.
Just 0.1%, that's barely moving.
Exactly. And emerging markets, interestingly, are quite varied. Some are actually benefiting from currency FX appreciation, meaning their currencies are getting stronger.
Right.
And increased investment flows. They're reporting average currency gains of like 10% year-to-date in some cases.
So a clear sense of slower overall momentum globally, but definitely with regional differences. Are the primary forces threatening to rock the boat here? What are the biggest headwinds we should be watching?
Well, the outlook is really shaped by a powerful trio of challenges. There's ongoing trade tensions, elevated geopolitical risks, and significant fiscal challenges. What's crucial here, I think, is that global uncertainty continues to prevail at record high levels. And that's leading to a synchronized decline in the economic cycle across both developed and emerging markets, a concerning trend we last observed back in late 2022.
Okay, let's zoom in on those trade tensions. We've heard so much about tariffs. The report mentions a trade truce with China. Can you shed some light on the nuances of that? And why is the U.S. tariff rate still, historically high?
Yeah, it's a bit complex. On the trade front, the U.S. global import tariff rate has seen a rapid reduction recently, dropping from 25% down to 13% since early April.
Okay.
Now, that's largely due to this trade truce with China, which brought the U.S. bilateral tariff rate, that's the rate applied specifically to imports from China, down significantly, from 103% down to 39%.
That's a huge drop for China specifically.
It is. However, it's really crucial to understand that the overall U.S. global import tariff is still at its highest level since 1940.
Wow, since the 40s.
Yeah. So this truce, while it's impactful, it feels pretty fragile. Threats are still looming, things like potential additional tariffs of, say, 50 percentage points on the EU, and there are reciprocal tariff deadlines coming up, I think, July 8th. Plus, sector investigations continue for things like automotive products, copper, pharmaceuticals.
So it sounds like a very delicate situation, a fragile truce indeed. Beyond trade, the report highlights significant U.S. fiscal challenges. What does that picture look like? Is there a risk of maybe stagflation?
The U.S. definitely faces considerable fiscal and monetary hurdles. The fiscal deficit is projected to exceed 8% of GDP by 2026.
8%.
Which means interest payments on the national debt are rising considerably. This escalating debt burden, combined with persistent inflation concerns and a recession probability exceeding 30%.
Yeah.
Well, it does indeed raise growing concerns about stagflation.
Right, that nasty combination.
Exactly, that tricky scenario where you have high inflation alongside stagnant economic growth and high unemployment. It's a real worry.
And shifting to Europe, how are geopolitical factors playing into their outlook, especially things like defense spending and, the ongoing conflicts?
Well, most NATO members in Europe are now surpassing that 3.5% of GDP defense spending threshold.
Yeah.
It's a notable and accelerating shift. However, a key risk here is that capacity bottlenecks and reliance on debt financing for this surge in spending. Well, that could push up long-term interest rates across the continent. Meanwhile, geopolitical strife, particularly in the Middle East, keeps uncertainty exceptionally high.
Sure.
Now, while that conflict has pushed oil prices up over 20%, the report suggests the economic fallout will likely be limited unless escalation leads to pivotal disruptions, like, say, a closure of the Strait of Hormuz.
Oh, right. That would be huge.
Yeah. If that vital shipping lane were blocked, it could spike oil prices to maybe $120 a barrel, with significant ripple effects across the global economy.
Okay. So given all these pressures and the varied regional outlooks, how are central banks globally responding? We often talk about the Federal Reserve in the U.S. What's their strategy in this environment? Are they holding steady or ready to make a move?
The U.S. Federal Reserve is indeed taking a cautious stance. They're expected to maintain interest rates at 4.5% right through until December 2025.
Okay, holding for quite a while then.
Yeah, largely due to those persistent inflation concerns, which are actually forecasted to peak at 3.9% by the fourth quarter of 2025. Their path forward seems to involve gradual rate cuts, eventually reaching maybe 3.5% by the third quarter of 2026. Slow and steady.
So a measured approach from the Fed. How does that contrast with, say, the European Central Bank, the ECB? Are they on a similar path, or is there a significant divergence?
Oh, there's a clear divergence. The European Central Bank, the ECB, is very much continuing its easing cycle.
Meaning cutting rates.
Exactly. They are cutting rates amidst low growth and disinflation, with rates expected to drop all the way to 1.5% by year-end 2025.
Wow, 1.5%. That's low.
It is. And the ECB is also aggressively reducing its bond holdings by an average of EUR 55 billion per month, effectively withdrawing liquidity from the market.
So we have the Fed holding steady, maybe easing later, and the ECB actively cutting now. What about other developed markets like the UK and Japan? And then that incredibly diverse landscape of emerging economies.
Right. Well, the Bank of England is expected to continue its gradual easing in 2025. Rates projected to reach maybe 3.75% by December 2025, then followed by a prolonged pause through most of 2026.
Okay.
The Bank of Japan? Likely to remain cautious, probably delaying its next rate hike until January 2026. For emerging markets, it's quite a different story. Again, you've got 32 large economies representing over 35% of global GDP. That will be easing monetary policy in the second half of 2025.
Easing. Okay.
Yeah, this is supported by that FX appreciation we mentioned, stronger currencies, and receding inflation. This easing is expected to continue into 2026 for many, though approaches do vary. Brazil, for example, is an exception, still fighting inflation with hiking cycles. So lots of divergence there, too.
We touched on the U.S.'s projected 1.6% growth earlier, which the report highlights as a significant slowdown compared to previous years. Let's really dig into why that momentum has cooled off for the U.S. economy. What does that mean on the ground?
Yeah, that modest 1.6% projected growth for both 2025 and 2026. It represents a substantial loss of momentum from the sort of closer to 3% growth seen in 2023 and 2024.
Right.
The primary drivers for this cooling seem to be those steep tariff hikes impacting input prices for businesses and consumer goods, basically making things more expensive. Additionally, tight immigration policies are expected to weigh on both demand by limiting new consumers and also the labor supply by reducing the available workforce.
Okay, that makes sense. Now, what's fascinating, as you mentioned, is how reported growth numbers can sometimes be a bit misleading. Can you unpack the Eurozone's performance again, especially given what you said about Germany? How much of that headline growth is really reflective of the underlying economy?
That's an excellent point. The Eurozone's reported Q1 2025 growth of 0.6% quarter on quarter.
Right.
Well, that was actually the fastest in 3 years.
Sounds good on the surface.
Right. But it was largely driven by an extraordinary 9.7% quarter-on-quarter growth from Ireland.
Ireland again.
Yeah. If you exclude Ireland, which has a unique economic structure due to its large multinational sector, Eurozone GDP only grew by a meager 0.2% quarter-on-quarter.
0.2. Okay, that's a huge difference.
It really is. And this stark difference supports the view that despite low inflation, the underlying economy is still in, well, pretty rough shape and needs more sustained monetary policy support, like those ECB cuts.
So outside of Ireland, the picture is considerably softer. What are the individual stories shaping the Eurozone's largest economies, like Germany, France, Italy?
Well, Germany is indeed slowly emerging from recession. They have a bold fiscal plan expected to drive recovery, but really from 2026 onwards. So 2025 is still very slow. France looks set to see a cyclical trough in 2025 at about 0.6% growth, with political instability flagged as a key downside risk there. Italy's economic activity held up relatively well, also at 0.6% in 2025, supported by solid investment and strong absorption of those NGEU funds.
The recovery funds.
Yeah. Exactly, the next generation EU recovery fund. Spain continues to show robust performance, projecting growth of plus 2.2% in 2025, driven by a buoyant tourism sector and also effective use of EU recovery funds.
Spain's doing well then.
Comparatively, yes. The UK is expected to experience soft growth at plus 0.9% in 2025. That's due to tax hikes, high inflation, and elevated borrowing costs. And Japan's growth remains sluggish at just plus 0.8% in 2025, after narrowly escaping recession in 2024, challenged by high cost of living and persistent uncertainties.
Okay, a real tour around the developed world there.
Yeah.
Now, moving to emerging markets, the report mentions China's stability. What's driving that, and how much policy support is still needed there? Is the government having to step in heavily?
China's GDP growth forecasts remain unchanged at plus 4.5% in 2025 and plus 4.2% in 2026. So stable, yeah. The impact from net exports is actually expected to be smaller than previously anticipated, largely thanks to that trade truce with the U.S. And also ongoing trade diversification efforts. Basically, China's finding new markets for its goods.
Okay. This is significant because it implies authorities may not need to significantly step up stimulus beyond what's already been announced. The economy seems to be showing some organic resilience.
And what about broader emerging market trends? Is it a rising tide lifting all boats, or are we seeing increasing regional divergence there as well?
Definitely significant regional divergence. While emerging market economies overall are performing better than maybe previously expected, headwinds are picking up. Growth in EM excluding China is forecast to reach plus 3.3% in 2025. Emerging Asia is likely to face a continued slowdown, but on the flip side, central banks in Latin America, emerging Europe, and Africa, they can actually afford bolder monetary policy easing into 2026. They're benefiting from those strengthening currencies and receding inflation we talked about.
So some EM slowing, others easing policy. Any standouts?
Yeah, Vietnam stands out as the fastest growing large emerging market at plus 6.0% projected for 2025. And India also shows robust performance with consistent growth rates around plus 6.2%.
Wow.
So bright spots for sure.
This brings us to a really interesting question. How are businesses navigating this complex environment, particularly across the Atlantic? Is this shaping up to be a cruel summer for corporate profitability, or are there bright spots?
It's certainly a mixed picture, and there's a clear transatlantic divergence in corporate earnings, especially looking at Q1 2025. U.S. aggregate EPS, that's earnings per share, a key measure of profitability, rose by a strong plus 14.6% year-on-year.
Pretty healthy.
Yeah. While European peers managed a more modest plus 5.5%.
Go.
However, beneath the surface, Europe actually posted better earnings growth in 14 out of 20 sectors, led by aerospace and defense, with a remarkable 72% EPS increase.
So the headline number hides some underlying European strength.
Exactly. The U.S. dollar strength plays a crucial role here. A weaker U.S. dollar is generally supportive for U.S.-based multinationals, right? Because foreign revenues translate into higher dollar amounts when converted back. Conversely, European companies with significant U.S. market exposure are facing a currency headwind. Their dollar-denominated revenues convert into fewer euros. And that impacts the top line, the overall revenue figure, significantly.
That's a striking contrast in earnings, even with Europe's underlying sectoral strength. This raises an important question, I think. How are firms managing their inventories in such an uncertain climate? Are we seeing different strategies play out between the U.S. and Europe?
Absolutely. And it's quite telling. U.S. firms have demonstrated remarkable agility by aggressively shedding inventories. Their days inventory outstanding, which is basically how quickly a company is turning its stock into sales, fell by 2.6 days in 2024.
So they're keeping things lean.
Very lean. Despite a surge in imports, particularly in pharmaceuticals, due to companies ordering ahead, front-loading, goods were apparently routed straight to consumers and distributors rather than being hoarded in warehouses. It shows a very responsive supply chain.
That's quite an efficient approach. But you mentioned Europe is a different story. So if the U.S. is shedding inventory, what's happening on the European side? Are they less agile, or are other factors at play?
Well, in Europe, it really is a different story. Days inventory outstanding actually increased, marking the fourth consecutive annual rise.
Increased. So they're holding more stock.
Yes. European corporates are effectively warehousing risk, as the report puts it, due to sluggish demand and already full warehouses. They're also acting as sort of hidden banks, extending about EUR 11 billion in trade credit to clients between Q4 2024 and Q1 2025.
Meaning they're letting customers take longer to pay.
Exactly, which means cash is stuck, either physically in warehouses as unsold goods or on customer ledgers as unpaid invoices. It ties up capital that could be used elsewhere. You could argue it's a cautious approach, maybe, but it certainly suggests less dynamism compared to the U.S. right now.
That contrast in inventory strategy is stark. Warehousing risk versus shedding inventory. What does this mean for corporate health overall, especially concerning insolvencies? Are we seeing businesses buckling under the pressure?
Unfortunately, yes. The trend isn't great there. Global insolvencies rose by 6.5% in Q1 2025, and the expectation is for a 7% increase globally for the full year.
7% increase.
Yeah, which means 3 out of 4 countries will be above their 2016-2019 pre-pandemic levels for insolvencies.
Oof. Any particular sectors feeling the heat?
Several are particularly stressed. The automotive industry is under immense pressure. European auto OEMs, for instance, saw a huge negative 28% drop in EPS.
Minus 28%.
Yeah. Construction in the U.S. faces profitability squeezes from rising wage pressures and labor shortages. Pharmaceuticals are actually on a negative watch list due to potential regulatory changes and cost pressures. And chemicals and metals are also flashing red, with widespread EPS declines and those high inventory burdens we talked about.
So we've navigated this complex landscape. Slower growth, central bank divergence, different corporate strategies, stressed sectors. What does all this mean for capital markets? Are they feeling the cruel summer vibe, or are there reasons to be walking on sunshine?
It's quite remarkable, actually. Despite all the heightened geopolitical tensions and tariff uncertainty, capital markets have shown really surprising resilience. Equity markets, in particular, staged a rapid V-shaped recovery following what the report calls Liberation Day, a term they use for a significant market turning point after a period of high uncertainty.
Liberation Day.
Okay, yeah. And European equity markets are up an impressive 18% year-to-date.
18%, despite the slower growth outlook.
Exactly. Now, while significant further outperformance is probably limited in the near term, the outlook is still positive. We expect U.S. total returns around 4% and EMU at 18% in 2025. By 2026, performance is expected to normalize a bit, with both U.S. and EMU total returns perhaps around 7%. Still decent.
Okay, so equity's holding up well. What about bonds and currencies?
For bonds and currencies. Well, government bond yields are expected to stabilize around current levels, but likely remain volatile. U.S. 10-year rates are anticipated to stay elevated. That's partly due to the high deficits and maybe less appetite from foreign investors.
Makes sense.
The euro has gained more than 10% against the U.S. dollar so far in 2025, which is significant. But the baseline outlook doesn't foresee much further USD depreciation. Expect USD may be hovering around the 1.15 mark. In credit markets, investment-grade credit spreads. They widened after those tariff announcements back in Q2, but they've since rallied back to near historical lows.
So still tight spreads.
Very tight. We expect maybe mild upward pressure from these low levels as long as uncertainty persists, but nothing dramatic expected right now.
And what about private markets? Those can often be a good barometer of underlying confidence and opportunity, maybe less swayed by daily headlines. Did they also experience this Liberation Day bounce, or they're still navigating turbulence?
Private markets also experienced some turbulence post-Liberation Day, yeah. But the underlying sort of structural demand for private assets remains strong. Investors are increasingly favoring managers with real operational depth and sector expertise. They want people who know what they're doing.
Makes sense in uncertain times.
Exactly. Private equity face uncertainty, but opportunities definitely persist in resilient sectors like healthcare, business services, tech. Direct lending, for instance, really shone during the recent volatility. It offered certainty and speed when the syndicated loan markets kind of stalled.
Right.
Real estate is finding its footing, particularly in logistics and multifamily assets. Opportunities are brewing in segments tied to demographic shifts and structural demand, and infrastructure. Interestingly, it's moving from being just a defensive play to more of an offensive strategy, driven by all the government investment in energy transition, digital infrastructure, and resilient transport. Lots happening there.
We've covered a tremendous amount of ground today, really navigating a complex global economic landscape. We move from the broad strokes of a slower global growth environment, that summertime sadness in the aggregate numbers, to the surprising walking on sunshine we've seen in capital markets, particularly equities.
We've explored how trade policy, central bank divergence, and those different corporate adaptation strategies, like the U.S.'s inventory agility versus Europe's warehousing of uncertainty, are shaping the economic narrative across regions and sectors, from the U.S. and Europe to the very varied emerging markets.
It really raises a provocative thought, doesn't it? Given this complex, evolving landscape, trade tensions, central bank divergence, very different corporate strategies, what does economic resilience truly look like for businesses and economies in the coming year? I mean, beyond just the headline growth numbers. How will the divergent approaches we discussed, that U.S. agility versus European caution, perhaps how will they play out in the face of this persistent global uncertainty, and what will that really mean for the next phase of the global economy?
It's a great question to ponder. We encourage you, our listeners, to consider how these powerful global forces might impact your own understanding of the economy and perhaps even influence your everyday decisions.